Stocks at a 52-week low are a great place to start looking for value, and in this video, I'll be analyzing 3 companies which are trading near their 52-week low. Stock number 1 is Nike, which is down 50% from its all-time high and has a market cap of $140 billion. Looking at their financials, they have grown revenues consistently from $27 to $51 billion, with the exception of COVID, which is an average of 7% annual growth. Their free cash flow has grown from $2 billion to $4.8 over the past 9 years, and their EPS has gone from $1.49 per share in 2014 to 3.2 currently. Analysts are expecting them to keep growing on top and bottom line, reaching $67 billion in revenue and $6.39 per share in 5 years. Their margins have consistently been around 10%, again with the exception of COVID, and I believe they could improve as they sell more direct to consumer. Then, in order to determine Nike's intrinsic value, I use my Google Sheet, which tells me at what price you should buy a stock based on the assumptions about the future of the company that you put in. I did a 7-year analysis with low, middle, and high assumptions. These 3 numbers are the intrinsic value according to net income, and these 3 according to free cash flow. They mean that in order to make the desired annual return that I have put in, which is 12%, you need to pay these prices. They also mean that if the low assumptions occur, you're going to make a 3% annual return on your money, middle 9.5%, and high 16%. I assumed annual revenue growth of 4% on my low assumptions, 6% on the middle, and 8% on the high, a profit margin and free cash flow margin of 9, 11, and 13%. I assigned a PM price to free cash flow at the end of the 7 years of 18, 20, and 22, and assume they buy back 2% of their shares annually for the next 7 years, which is what they have been doing. These returns include the dividend, which currently has a yield of 1.5% and appears to be safe as the payout ratio is 43%. Moreover, they are selling at a P of 27 and price to free cash flow of 22, and they have a very good balance sheet with $10 billion in cash and only 12 in debt. In conclusion, Nike is a fantastic company that is going to keep growing as they have the best athletes in the world. I believe it is trading around fair value, and I am personally waiting until it drops to $80. Stock number 2 is CVS, which is down 25% in the past month after they reported very bad earnings, missing on both EPS and revenue, and lowered full-year profit outlook. They have 25% of the prescription drug market share, and looking at their financials, they have grown their revenue from $139 billion to $357 billion over the past 10 years. Their net income from $4 to $8 billion and free cash flow from $6 to $10. They are still expected to keep growing and reach $453 billion in revenue and $11.70 per share 5 years from now. If you assign a 10p to the company then, it would make it a $117 stock, meaning 109% upside. Then, the company also looks very attractive on the Excel spreadsheet, with an intrinsic value between 54 and 125, and the stock is currently trading around $55 per share. Moreover, if the low assumptions occur, you are going to make a 12% annual return on your money, middle 21.5%, and high 30.5%. Again, these returns include the dividend, which has a 4.7% yield and is healthy as the payout ratio is around 45%. They are also trading at a forward PE of 6 and price to free cash flow of 8, and therefore we can conclude that the company is trading cheap. However, this company has $81 billion in debt, which is a lot, and this, in my opinion, is a big risk in investing in this company. In conclusion, I believe CVS has a lot of upside potential as well as a lot of risk because of the debt. Stock number 3 is Johnson & Johnson, which is down 8% over the past year and has a market cap of $357 billion. This is not a fast-growing company, as they have grown at an average of 3% annually over the past 10 years. Their net income has been between $16 and $20 billion, with the exception of this year, where it jumped to $35 billion because of a one-time income from discounted operations, and therefore we do not have to take this into account. This is why the PE looks very cheap at 9, and I would focus on the price to free cash flow, which is 19. As you can see, their free cash flow has been more consistent. Then, according to my assumptions, the company is worth $99 per share according to my low assumptions, $122 according to my middle, and $161 according to my high. The stock is currently trading at around $150, and if the low assumptions occur, you're going to make a 3% annual return, middle 8.5%, and high 13.5%. This company has $33 billion in debt, which is not a lot for the size of this company, and they have a lot of cash, $26 billion, which they are going to use to reward investors by buying back shares, which they have already been doing, and by paying a dividend, which currently has a 3.3% yield and has a payout ratio of 32% and is therefore healthy. This company has also a very good ROIC, or return on invested capital. It's 18%, while the market average is around 10%, meaning they are very good at investing its capital in order to increase profits. In conclusion, I believe Johnson & Johnson is a fantastic company that is very diversified, both in terms of products and in terms of geographic locations. I would like to own this company, but not at current prices. I am interested around 120. I hope you found this video valuable. Let me know what you think about these companies in the comments, and I'll see you in the next one.